welcome back. It's Gigi. So today I'm going to talk about tax advantage account and taxable account. All you need to know, some basic information. Let's get started. So first, what is tax advantage account? With that said, means you get some tax benefit from using those accounts. When you put your money in there, it could be a pre-tax, or when you take out money from those accounts, it could be from tax exempted. So there's a couple accounts that I'll be talking. And taxable account, it's very straightforward, meaning that account don't have any tax benefits, but they offer fewer restriction and more flexible. And it's taxed according to whatever your tax income, or it depends on which product you're using. Tax advantage account, there's one called tax deferred account, allow you to realize immediate tax deduction on the full amount of your contribution, but future withdrawal from the account will be taxed at your ordinary income rate. So for example, 401k through your employers. And there's also traditional IRA, simple IRA, SEP IRA, solo 401k. So all this retirement account. So if you're self-employed, you can open a solo 401k or a SEP IRA for tax deduction purpose. How you should utilize these two accounts to achieve your financial independence. So let's see. So 401k is through your employer, and very often your company may offer 401k match. So you will need to review the contract with your employer. If they do have a 401k match to your contribution, definitely take the advantage of that because it's free money. There is a limit actually. According to tax year 2020, IRS state that the contribution limits would be $19,500. At the same time, when you contribute to the 401k, depends on which platform your company is using, you can allocate your investment into different funds like target fund. And of course, there's some withdrawal rules of 59 and a half age, early withdrawal penalty. But it will be different throughout the year. Like let's say right now, because of coronavirus, the government passed the CARE Act, which allow you to withdraw up to $100,000 from your 401k, only for the coronavirus purposes though. And there's another type called traditional IRA. And there's an income limit actually and contribution limit. I'll put the link down below. For traditional IRA, if you meet the income limit and the contribution limit for 2020 would be $6,000 for the year, which means let's say you put $6,000 in traditional IRA, and you can actually deduct the $6,000 from your gross salary to lower your adjusted gross income. Another type of tax advantage account, which is tax exempt account. So it provides future tax benefits. And when you withdraw at your retirement age, you don't have to pay any tax. For example, Roth IRA and Roth 401k. A lot of people throughout the financial independence journey, they talk about traditional IRA and Roth IRA. So let's look into what's Roth IRA. Are you eligible for Roth IRA? When I talk about this and ask you this question, it's also because there's an income limit. If you fall below the income limit, you are eligible to contribute, and it would be tax-free when you take the money out from your account. Between $196,000 to $209,000 for married, file jointly, and then for single, I don't remember, $139,000. I will put the link below. I will talk about it at the end. The contribution limit for one tax year is $6,000. And it is very interesting that because I never really thought about Roth IRA before I started doing all this research about financial independence. And actually, I just started opening this account months ago, and yes, contributing $6,000. And what's the benefit of Roth IRA? And also same with traditional IRA is that you can actually invest your money to stock. Different index fund, and which is very important throughout this journey is you invest in index fund. Everybody talk about how you grow your money through the compound interest in the index fund without any tax at the end when you withdraw the amount. This Roth IRA is your after-tax contribution. So when you withdraw this, you get tax-free, no penalty on the contribution at any time. But the key word here is contribution. And some people might say, oh, Roth IRA, I would rather do traditional IRA and 401k first because I would like to take the tax deduction benefit right now. At the end, you have to pay taxes when you withdraw from those accounts. And there's a very popular way called Roth conversion letter, a 5 years rule, which I will actually have a separate video just talking about this benefit of doing Roth IRA or having a Roth IRA account. It allows you to convert your 401k and traditional IRA money to Roth IRA, but at the same time, of course, you have to pay tax in between. But you can actually withdraw the money after 5 years sitting in the Roth IRA without any penalty. Because when you think of 401k and IRA, when can you withdraw the money? You have to reach your age at 59 and a half. Let's say you retire early throughout the financial independence journey. You want to retire at 40. What should you do with all the money in 401k and traditional IRA? Actually, you can put the money to Roth IRA. You pay the tax. And of course, there's other strategy how you use that conversion. So I will talk about it in the next video. Then the money that you convert, you put 5 years. 5 years later, you can take it out without any penalty. Yes, I will make a video about that. How you would like to utilize those accounts to invest versus just the taxable account, which is the brokerage account. I don't have a slide to talk about the taxable account in detail because it's just regular brokerage account. When you have your long-term, short-term capital gain, you pay the tax according to the IRS instruction. But I will actually talk about that if you guys are interested in the details about the capital gain tax. So under your tax advantage account, which means your 401k, traditional IRA, you should put tax inefficient asset in those accounts. What does that mean? It means that those investments usually have significant capital gains. So when you think of that as Tesla, but before Tesla had almost 300% gain in the month of August. So you would like to have that in there. And let's say in Roth IRA, you invest Tesla in Roth IRA. When you take it out at the age 59 and a half, the capital gain is tax free. Investment you would like to put in those tax advantage account would be high dividends investment or high dividend ETF. Because when you have high dividend, which means you have making more money, and you don't want those money to get taxed, or you have to pay capital gain through that. And also things that you frequently buy and sell, which usually stocks. You would have more buy-sell opportunity if you're trading stocks. For example, under those high dividends ETF, I would say REITs, the real estate ETF, that's also often offer high dividends. When we compare to taxable account, which is a brokerage account, no matter you open it through TD or Robinhood, anything, you would like to invest in tax efficient assets such as low yielding fund or bond, something that's low return like the total stock market index fund with Vanguard, and also something with slow growth, so you can have like a long-term investment without making too significant capital gain and you have to pay for the capital gain tax. I will look at your comments and see what topics you guys are interested in learning. And very important for the financial journey is how you prioritize your saving with those account and investments. First, you have 401k with your employers. There's also 403b, 457. If you're self-employed, would be SEP IRA or other retirement account for self-employed. So next, you would like to build up your emergency funds. Let's say you have money. First, you contribute to your 401k to get the tax advantage and tax deduct from your income, and next you would like to form your emergency fund. Some people do 3 to 6 months of expense. Some people like to have 2 years in case they lose their job. Those are emergency funds that you will need to have in your bank account. And then if you have more money, definitely take advantage of all these three. Actually, I didn't talk about the HSA. It's very useful if you have HSA, because that account is also pre-tax. You pay it when you withdraw it, and at the same time you can invest in those accounts like the traditional IRA. And of course there's a limit, $3,500 this year I think, and then $7,000 for a family. And also put in your traditional IRA if you meet the income limit, and after that, if you have more money, put into Roth IRA. Then next, let's say you have even extra money that you have left, max out your 401k, max out your retirement account, take the full benefit of the tax deduction. Then if you have kids, open a custodial account now to start making investment just like your regular IRA account, but then it's a custodial account for your kids. Some people would say do the 529, but 529 may have limit restriction because you can only use it for education expense. But custodial account, you can do it with anything. Open one with Vanguard or a different bank that you do research about it. And last, you would like to put in, let's say you max out everything, you put the money in your IRA and traditional IRA, you still have money left over in your bank account. Even after forming your emergency funds, you should put it in your brokerage account to buy the total stock market index fund. And I'll talk about that later with brokerage account and how you have your tax strategy when you withdraw the money, or how you utilize this account to form your plan when you retire. Do put this in your budget sheet that I talked about in the last video. Then you will have your first step to Journey of Fire. So I'll have link below for any income limit and contribution limit that you can take a look at for your reference. Thank you guys for watching. Please subscribe, like, and share. Also comment down below of what you'd like to hear in the next video. Bye!